Welcome to the deep dive. Today we're opening a file on a figure so colossal, so omnipresent in our financial lives. It almost feels less like a statistic and more like the air we breathe.
It really does.
We're talking about $315 trillion. And that isn't just a big number, it's the total cumulative debt owed globally. That's governments, corporations, households, everything, all combined.
It's the elephant that's just taken over the entire global living room, isn't it?
Yeah.
When you even try to contextualize a number like $315 trillion, you realize you're dealing with a phenomenon that is what? Roughly 3 times the size of the entire global annual economic output?
3 times the gross world product.
Exactly. I mean, that suggests a level of leverage that, on any personal balance sheet or even a corporate one would be triggering every alarm bell in the building immediately.
Yeah, exactly. And that stunning leverage brings us right to the core puzzle, the central mystery we're really setting out to solve in this forensic investigation. We've been calling it the Mars paradox. If you look around, every major entity is just massively in debt. The U.S. owes money, the EU owes money, China owes money, companies are leveraged to the hilt, homeowners have huge mortgages. So if every debtor is staring at this impossible liability, well, logically, someone somewhere must hold the corresponding $315 trillion asset. The critical question is, who is the creditor?
And that's the whole thing. In any rational closed-loop financial system, the sum of all liabilities has to equal the sum of all assets. It just has to.
Right.
If I borrow $100 from you, the net financial position of our little two-person system hasn't changed at all. It's still zero.
Right.
So for the global system to report a net debt of $315 trillion, well, unless we took out some colossal loan from an entity outside our planet's financial system.
Unless we literally borrowed it from Mars.
Exactly. Unless we borrowed it from Mars, we owe to ourselves. The debt isn't a deficiency.
Yeah.
It's a mirror.
And here is the truly provocative thought, the mission statement for this entire deep dive. If we owe it to ourselves, then why all the panic? And more importantly, why are taxpayers globally paying hundreds of billions of dollars every single quarter in interest payments? Our investigation shows this isn't a mistake. It's not a math error. It's not some temporary political failure. It is, by design, a very sophisticated financial architecture.
And our purpose today is to pull back that curtain. We want to reveal how this gargantuan debt load functions, not as a simple liability, but as the fundamental operating system for modern finance. It's a system that, while it ensures stability in the banking sector, is also structurally designed to facilitate a continuous, non-stop transfer of wealth.
From one economic class to another.
Precisely. The debt is, in essence, a sophisticated trap that every informed learner really needs to understand to navigate what's coming.
Okay, so let's unpack this closed system, and let's start with maybe the most enduring and certainly the most politically charged misconception in all of modern finance. I'm talking about the China myth.
Ah, yes, the boogeyman.
The boogeyman, exactly. Every election cycle, we hear this narrative, right? It's often weaponized by politicians who want to rally voters or justify, say, protectionist policies. The line is always, we are in debt to China.
Or that China holds the power to cripple the U.S. economy by just dumping all its treasury holdings at once.
Yeah.
It's a fantastic political narrative.
Why?
Because it provides convenient foreign enemy. It diverts all the scrutiny away from the true domestic mechanisms of the debt. It's a classic misdirection.
So let's look at the cold, hard forensic evidence. We're talking about the U.S. national debt, which is currently sitting, north of $36 trillion now?
That's right. And our sources confirm that of that $36 trillion, China holds approximately $800 billion.
Okay, now let's be clear. $800 billion is an astronomical figure by any normal measure. But if we put that into the context of the total $36 trillion,
it's a drop in the bucket.
It's about 2%, roughly 2% of the total U.S. national debt. It's a significant holding, yes, but it is hardly the controlling interest that all the political rhetoric would have you believe.
China is a marginal player. A very, very marginal player in the grand scheme of the U.S. balance sheet.
So that's the key question then. If only 2% is held by this perceived foreign antagonist, who in the world holds the other 97%?
And the answer is, we do. The vast majority of U.S. debt is held by domestic entities. We're talking about the absolute bedrock institutions of American economic stability.
So who are we talking about specifically?
We're talking about massive U.S. pension funds, insurance companies, mutual funds, commercial banks, individual investors, state and local governments, and this is a big one, the Federal Reserve itself.
Let's focus on those 3 key institutional holders for a second. Pension funds, insurance companies, and the Fed. Because this is really where that concept of the closed loop starts to manifest, isn't it?
Absolutely. These institutions, collectively, they represent the savings and the systemic stability mechanism of the entire nation. Well, just consider a large public or corporate pension fund. They've made promises. They have promised fixed payments to retirees 20, 30, even 40 years from now. They cannot risk those funds on volatile assets like, tech stocks or crypto.
No, of course not. They need safety.
They need the safest, most liquid, and most reliable return stream available on planet Earth. So what asset fits that description?
The U.S. Treasury bond.
The U.S. Treasury bond. They're deemed risk-free in dollar terms. These funds are structurally compelled to buy huge quantities of U.S. debt just to meet their long-term obligations. They have no choice.
So when the government needs to borrow money, say, to cover the gap between what it spends and what it gets in taxes or to fund the military, it issues a new Treasury bond. This is basically just an IOU.
Correct. The government issues the IOU, and a pension fund buys it. They exchange their current capital for a guaranteed stream of future interest income. That's the first half of the loop.
Okay, so what's the second half?
The second half is the interest payment. The interest payment on that bond is guaranteed by the full faith and credit of the United States. And where does the government get the money to pay that interest?
From us. From taxpayers.
It comes overwhelmingly from the general tax base. From you, the taxpayer, primarily through income taxes and payroll taxes. So the working population pays taxes, which the government then uses to service the debt. That interest payment flows directly into the coffers of the U.S. entities we just named, the pension funds, the insurance companies.
And here's the profound irony, the thing that makes this system a circular mirror.
Yeah.
That pension fund, it eventually pays out the retiree.
Right.
And who is that retiree? Very often, that individual is the exact same taxpayer who just spent decades of their working life funding the interest payments on the debt that provided the guaranteed return in the first place.
It is a brilliant, self-sustaining financial circle. It's perfect. The government is essentially issuing IOUs to its own population savings vehicles. We aren't just saving for the future. We have literally financialized our own future consumption and security through guaranteed government debt.
The system demands this debt.
It has to have it. The stability of the entire retirement system, the insurance markets, the fundamental liquidity of the banking system, it is all predicated on the continuous existence and ownership of these T-bonds.
Okay, but I think we need to push back on one point here. If the Fed itself owns a big chunk of this debt, isn't that just a simple intra-governmental accounting trick? I mean, why should we even include that in the $36 trillion national debt figure if the government just owes it to its own central bank?
That's a crucial point, and it's why understanding the architecture is so vital. You're right. In many ways, the interest paid by the Treasury to the Fed is an accounting loop, because the Fed typically remits its profits right back to the Treasury.
So it's a wash.
It seems like a wash, but the sheer existence of that Fed-held debt is a profound indicator of systemic strain. The Fed primarily steps in as a buyer when market demand from pension funds, from foreign banks, from whoever, is insufficient to absorb all the debt the government needs to issue.
So when the Fed becomes a major creditor, it's a signal.
It's a huge signal. It signals that the system needs monetary life support. It means debt is being monetized. It's a tool for liquidity management and inflation control, and the scale of their holdings demonstrates a structural demand for debt that simply cannot be met by organic savings alone.
So the debt isn't some external problem. It's not an imposition. It's the internal plumbing of our whole system.
Right.
And that realization, it just flips the entire debate on its head, doesn't it?
Completely.
It's not about being beholden to China. It's about being structurally dependent on this massive debt instrument for our own domestic financial stability. And this dependence, this sets us up perfectly for the next section, the collateral trap. The reason why this debt can never, ever be paid off. That structural necessity leads us directly to the intuitive, the common sense question asked by what you call the dumb money.
Right.
If we owe the money to ourselves and we have the sovereign power to tax ourselves, why don't we just mandate a balanced budget, stop issuing new debt, and systematically pay off the existing $36 trillion over the next, say, few decades?
I mean, from a moral and fiscal perspective, it sounds like the responsible adult thing to do.
It sounds perfectly responsible. If you're running a household or small business, that's exactly what you should do. But on the level of macrofinance, doing that would be like removing the foundation of a skyscraper while you're still living on the top floor.
You're saying it's a structural impossibility.
It is a structural impossibility whose execution would guarantee an immediate, and I mean immediate, global financial collapse.
Right.
This is the collateral trap. And if you understand this mechanism, you understand the fundamental lie at the heart of all modern monetary policy. Okay, so let's define the key players here. What makes a U.S. Treasury bond fundamentally different from, say, a highly rated corporate bond from Apple or a AAA-rated municipal bond? Why is the UST bond this one singular asset that is so necessary for global finance?
That is the crucial distinction. In the modern financial system, U.S. Treasury bonds are not just a government liability. They are the purest form of pristine collateral available anywhere in the world. They are, and this isn't an exaggeration, the gold of the digital age.
Why pristine?
They carry zero counterparty risk in dollar terms, meaning the issuer, the U.S. government, can always pay the debt back simply by creating the currency. Other assets, even super high-grade corporate bonds, carry credit risk. They can, and sometimes they do, default. The UST bond is the only asset with the requisite depth, liquidity, and sovereign backing to service the multi-hundred-trillion-dollar derivatives and shadow banking systems.
So let's focus on where this collateral is actually used. You mentioned the repo market. This is a term people often hear in the headlines, but I think it's rarely understood. So for our informed learner, let's elaborate on its function and its scale.
The repo market, or the repurchase agreement market, is the high-speed engine room of the global banking system. It's where banks, money market funds, other huge financial institutions borrow short-term cash, usually just overnight, to manage their daily liquidity needs. It is a massive, massive market. We're talking trillions of dollars in transactions every single day.
And how do they borrow this cash? What's the mechanism?
They do it by selling an asset, the U.S. Treasury bond, to a lender, a cash provider, with an agreement to repurchase it the very next day at a slightly higher price.
And that small difference in price is the interest.
That's the interest. But the key insight here is that the Treasury bond acts as the security, the collateral, that makes the lender comfortable extending that overnight cash. It eliminates the counterparty risk. If the borrower defaults, the lender doesn't care. They just keep the pristine collateral. This mechanism ensures trust, and it keeps the global liquidity taps running 24/7.
This all sounds incredibly abstract. Can you give us a real-world example of what happens when that collateral system gets strained, when the plumbing starts to back up?
Absolutely. We have a perfect one. Think back to September of 2019. This was a moment when the esoteric nature of this collateral trap just burst into the mainstream headlines. For a couple of technical reasons, tax deadlines, major Treasury settlement dates, there was a sudden, massive shortage of available cash in the repo market, while demand for that cash stayed very high.
Okay, so a supply and demand crunch.
A huge one. And it meant that the rate banks were charging each other for these overnight loans suddenly spiked. It went from the expected 2% to nearly 10% overnight.
Wow. And that spike, that indicated that banks were suddenly mistrustful, or they were just unable to access the collateral they needed.
Exactly. The system was seizing up. It was having a heart attack. If that spike had continued for even another day or two, it would have starved the banks of the liquidity necessary to function. It would have caused a chain reaction of failures in frozen credit markets all over the world.
So what happened?
The Federal Reserve had to intervene immediately. The very next day, they injected hundreds of billions of dollars into the repo market, effectively proving to everyone that they are the dealer of last resort. And why did they intervene? Not to stabilize the price of the bond itself, but to ensure the availability of the bond as collateral. They had to make sure the plumbing didn't fail.
That anecdote is chilling. It really is, because it confirms the underlying fragility of the whole system. And it means if the government were to actually succeed in paying off the national debt, every single one of those Treasury bonds would be extinguished. They would just disappear from existence.
Correct. The debt instrument that functions as the global benchmark for safety, the foundational collateral for trillions and trillions of dollars of shadow banking, would simply vanish. If the government retires the debt, there are no bonds left.
And no bonds means no pristine collateral for the repo market.
No collateral.
And if there's no collateral, interbank lending immediately ceases because all the trust evaporates. Liquidity freezes solid. The global derivatives market, which relies on these bonds for margin and security, would just seize up.
The global economy, which runs on the expectation of frictionless, low-cost capital transfer, would grind to a catastrophic halt overnight. We would be facing a liquidity crisis far, far worse than 2008. The analogy of a Jenga tower is too weak. This is the entire load-bearing structure of the skyscraper. You cannot remove the foundation simply because you think having a clean balance sheet sounds nice.
Wow. So the smart money secret isn't that the government is just spending money it doesn't have. It's that the government must keep issuing and rolling over this debt forever. not just to fund its day-to-day spending, but fundamentally to maintain the operational stability and liquidity of the entire domestic and global banking sector.
The debt is a necessary, permanent feature of the system.
Yeah.
It's not a structural flaw. It's not a temporary bug that some political party can come in and fix. And this realization, it fundamentally changes the nature of the conversation.
How so?
We should stop demanding that politicians pay off the debt, because that would be inviting an immediate collapse. Instead, our focus has to shift to recognizing and managing the inevitable cost of this permanent architecture.
And that cost, as we established right at the top, is the structural wealth transfer,
Right.
the ethical core of this entire closed-loop system. So we've established two major forensic findings so far. First, the $315 trillion debt is a closed loop. We owe it to ourselves. Second, the debt can never be paid off because it functions as the non-negotiable collateral that keeps the global financial lights on.
Right.
So if the debt must exist permanently, we now have to ask the hard question. Is this permanent architecture harmless? I mean, if the money is just cycling around and around, does it truly matter?
It matters deeply. It matters because ourselves is not one big unified entity. The system structurally divides the population into two opposed groups. You have the debtors, taxpayers on one side, and you have the creditors, bondholders on the other. And the architecture is designed to create a continuous, subtle, but massive transfer of purchasing power from that first group to the second. This is the real hidden price of systemic stability.
Let's elaborate on the vacuum cleaner analogy you use. How does this structural machine actually work in practice? How does it suck wealth from one group to benefit the other?
Okay, so the debt requires servicing. That means paying interest. Let's look at the source of that money. The cash required to service this debt, which, as we discussed, is now one of the single largest line items in the entire U.S. budget, is overwhelmingly collected from the working class. Federal income taxes, payroll taxes, other broad-based levies. These are taxes on labor, on production, on earning a paycheck. This represents money earned through current effort and time. This is the source of the vacuum cleaner. This is where the suction comes from.
Okay, so that's the source. What's the destination? Where does the money go?
The destination is the asset class, the bondholders. These are the holders of capital. The massive U.S. pension funds we talked about, the insurance companies, the mutual funds, wealthy individuals, institutional investors. The interest payments flow directly into the accounts of the people and institutions who own money, not necessarily the people who work for it.
And their returns are guaranteed.
Guaranteed by the full force of law and the collection power of the IRS.
So, just to be crystal clear, if the interest payments are guaranteed by the income tax revenues of the working population, this means the system is literally sucking purchasing power from people who rely on their labor for income, and it's depositing that power directly into the accounts of people who already own capital.
That's it.
It's a slow, structural shift of wealth, all under the guise of financial stability, and it goes a long way to explaining the widening wealth disparity we see all around us today.
That is the class war dynamic operating in stealth mode. Now, we're not alleging that creditors are villains or that debtors are victims. They are simply positioned on opposite sides of a fundamentally rigged structural trade that was established by the design of the global reserve system.
So the individual who relies solely on a paycheck is structurally subsidizing the guaranteed returns of the institutional owners of capital.
Relentlessly. That transfer occurs every second of every day through the payment of interest on government debt. It's the stability premium that is paid by the majority to the minority.
And this vacuum cleaner effect, it's not slowing down, it's accelerating, isn't it? Because the debt load itself is becoming structurally unmanageable under the current taxing and spending patterns. We've crossed a truly terrifying fiscal milestone recently.
The sources all confirm this inflection point. It happened around 2025. The annual cost of U.S. interest payments, now soaring above $1.1 trillion, has officially surpassed the entirety of the national defense budget.
Let that sink in for a moment. We are spending more money servicing the debts incurred by previous generations than we are on protecting the current and future safety of the nation. More than the Army, the Navy, and the Air Force combined.
It's a shocking statistic.
That is the clearest possible marker of a debt spiral, or what economists call fiscal dominance. Let's not just use that term academically. Let's define what it practically means for the government's options going forward.
Fiscal dominance is the moment when a government's budgetary constraints, specifically the crushing size of its debt and the required interest payments, start to dictate monetary policy. It means the government has reached the point where it must borrow new money just to pay the interest on the money it already borrowed.
It's the definition of a national Ponzi scheme.
It is. The only way to avoid default is to find new lenders, or if that fails, to use the printing press.
So in a state of fiscal dominance, the central bank, the Federal Reserve in this case, it effectively loses its independence. It can no longer focus solely on its dual mandate of fighting inflation or maintaining full employment.
Its primary job changes. Its number one job becomes accommodating the government's borrowing needs to prevent a financial market collapse. The Fed becomes dominated by the Treasury's fiscal necessity.
So the government is trapped. It's trapped by the collateral trap, so it can't default.
Right.
And it's trapped by fiscal dominance, so it can't tax enough to pay the interest. This leaves it with a very, very narrow set of choices.
An inevitable narrow choice. The choice is not default, because as we established, that would crash the entire banking system.
And the choice isn't drastic austerity, cutting spending to the bone, because that's political suicide, and it would trigger a massive economic depression.
So the only viable path forward is inflation. If the government cannot tax and it cannot default, it must inflate. That is, it must debase the currency to pay the $315 trillion liability with money that is worth significantly less in real terms.
So inflation acts as a kind of soft default.
It's the silent, unseen tax on everyone holding dollars. It transfers wealth from those holding currency or fixed income, that's the working and savings class, to the owners of tangible assets, the capital class.
So here's the big takeaway. Inflation is not a policy error. It's not an accident. It is the required structural policy outcome of this architecture, dictated by the need to manage this massive permanent debt load.
Exactly. It becomes an essential tool for the system to liquidate its own liabilities over time.
And this realization is profoundly important for you, the listener. The system is designed to exist permanently, to funnel wealth from labor to capital, and to use inflation to liquidate the entire structure over time. Once you accept that forensic finding, you realize that waiting for the debt to be responsibly fixed is a fantasy.
It's a complete fantasy.
So the only path forward is to stop being a casualty of this architecture and to start focusing on aligning your own balance sheet with this new reality of permanent debt and managed currency debasement.
That's the only game in town.
The investigation concludes then with a necessary shift in perspective. The architecture is fixed, the wealth transfer is systemic, inflation is the inevitable policy solution. So the strategic mandate for you, the individual learner, is clear. Stop waiting. Stop waiting for a political solution or some mythical great default.
They will never let it default. They will simply print, inflate, and refinance forever to save that collateral system.
So the goal is to stop being the taxpayer debtor, whose labor funds the system, and start transitioning into the creditor owner, whose assets actually benefit from the system.
And this requires a strategic, almost historical ruthlessness. And crucially, a shift in your personal psychology. To find a blueprint for how the smart money operates during these periods of high leverage and structural collapse, we can look back nearly a century. The best case study is Joseph Kennedy, patriarch of the Kennedy dynasty, and his legendary maneuver just before the 1929 stock market crash.
His story often gets simplified, right? People just say he sold his entire portfolio shortly before Black Tuesday. But the genius wasn't just the timing, it was the strategic recognition of structural saturation.
That's right. The famous anecdote is the shoeshine boy indicator. The story goes that when his shoeshine boy, the person at the very bottom of the capital formation ladder, was fully invested, giving him stock tips, bragging about his gains, Kennedy knew you had hit maximum saturation. The pool of greater fools had finally run dry.
That recognition signals the psychological peak of leverage.
It does. And Kennedy's strategy, the blueprint for navigating a leveraged collapse, it has three distinct phases. And the first is perhaps the hardest one emotionally, the exit. He sold his paper assets early.
He knew he was missing out on the final gains?
Oh, absolutely. He knew he was missing the final 10% or 15% of the boom. His friends on Wall Street undoubtedly laughed at him, called him a fool for leaving money on the table. But the strategy dictates you must be willing to look like an idiot and sacrifice those last gains to raise a massive war chest of liquidity.
That liquidity, that available cash ready to deploy, is the most potent weapon you can possibly possess when systemic leverage unwinds. If everyone else is getting a margin call, desperate for capital, and you are sitting on a pile of cash, you dictate the terms. That's phase one, raising the war chest.
So phase two for Kennedy involved hedging, shorting the market, profiting from the collapse itself, which is complex, it's high risk. But phase three, the reentry, that is what created generational permanent wealth. Kennedy didn't buy back the same paper stocks he sold.
What did he do?
He waited. He waited for maximum panic, for the moment the proverbial blood was in the streets in 1930 and 1931, when everyone was convinced that capitalism itself was dead.
And he used his massive cash war chest to buy tangible, real assets, the foundational infrastructure of America, at deep, deep discounts.
He famously purchased the Merchandise Mart in Chicago. He was buying irreplaceable physical assets, real estate, ports, infrastructure, for pennies on the dollar. He was buying a skyscraper for, say, $10 million when it had traded at $100 million just 2 years prior.
The core lesson of the Kennedy strategy is the successful execution of a wealth transfer, moving capital from volatile paper assets to discounted hard assets during a deleveraging event. When banks stop lending and prices plummet, liquidity becomes sovereign. If you have that liquidity, you become the ultimate creditor.
You become the new empire.
But, and this is a huge but, here is the critical adaptation we must make for the reality of 2026. An adaptation that fundamentally differentiates our time from 1929. In Kennedy's day, when he raised that cash war chest, the dollar was backed by gold. His cash was hard currency, it was deflation-proof.
And today, the context is fundamentally different. Our finding from Section 3 was that inflation is the inevitable policy to liquidate the $315 trillion debt. So if you attempt the Kennedy strategy today by just holding fiat cash, the unbacked paper dollar, the printing press that's required to service the debt will simply inflate your war chest away.
Your liquidity will lose its purchasing power rapidly while you're sitting there waiting for the panic. You cannot hold paper dollars like Kennedy did. They're toxic.
Absolutely toxic.
So we need a modern proxy for inflation-proof cash, something that fulfills the liquidity role of Kennedy's gold-backed dollars, but exists outside the inflationary pressure of this permanent debt architecture.
And that proxy is gold and silver. They're the only neutral reserve assets that hold value outside of the counterparty risk of the banking system and, crucially, cannot be printed by the government. And you don't have to take my word for it. Look at the central banks globally.
Not just individual investors.
Not at all. China, Russia, India, they are stacking physical gold at record rates. Why? Precisely because they recognize the coming debasement of the dollar. They are swapping paper promises, which are treasuries, for physical reality, which is gold, to preserve their purchasing power.
This strategic adaptation leads us directly to the actionable playbook for the listener. How to move from being the victim of this architecture to becoming the owner. And this is what you call the 3Gs framework for aligning your personal balance sheet with the empire's needs.
That's right. And the first step is a deep psychological mindset shift. You have to stop measuring your wealth in depreciating dollars. That's the unit of account the government is actively debasing. Instead, measure your wealth in ounces of gold, precious metals, acres of land, ground, or units of energy exposure, gas energy stocks. The assets are rising. It's the measurement unit, the dollar, that's falling.
Let's break down that first G in a bit more detail, gold and precious metals. You talked about the necessity of gold as a proxy for inflation-proof cash. For the informed learner listening, what's the key difference between holding gold via, say, a paper instrument like an ETF versus physical possession?
This is critical, especially when we're talking about systemic collapse or deleveraging events. Paper gold things like ETFs or unallocated accounts still carries counterparty risk. If the banking system or the ETF custodian experiences a crisis, your paper promise might be compromised. It might not be there.
The goal here is liquidity outside the system.
Exactly. Therefore, the purest form of the Kennedy war chest adaptation is physical allocated metal, actual ounces that you possess. This ensures that when the interbank lending system seizes up again, as it did in 2019, you hold the ultimate form of pristine collateral, completely free of default risk. This is the key component for your reentry strategy.
Okay, that makes sense. Let's move to the second G, ground. When people hear real estate, they often think of highly leveraged commercial properties or speculative housing markets. How does the concept of ground translate to a stable, inflation-proof asset in this context?
The focus has to be on assets that are productive or necessary and illiquid enough to resist the initial panic sell-offs. Think agricultural land or high-quality residential real estate that's tied to necessary housing demand. These are assets that will inflate in price because of the currency debasement, but they also provide a yield from rents, from crops. And critically, ground allows you to play the refinance game.
The refinance game.
Which is the necessary complement to the government's own sovereign debt strategy.
So, if the government is committed to refinancing its debt forever and paying it off with progressively weaker and weaker currency, what does that imply for, say, our cheap fixed-rate personal mortgages?
It implies that inflation is your best friend in that scenario. If you have a fixed-rate mortgage at, say, 3% or 4%, and official inflation is running at 6% or 8%, you are receiving a massive structural subsidy from your lender. You are paying back your loan with money that is worth significantly less in real terms than the money you borrowed.
So the old advice to pay off your mortgage as quickly as possible might be wrong in this environment.
For cheap, fixed-rate debt, it's terrible advice. You must align your personal debt strategy, which is leverage on hard assets, with the sovereign debt strategy, which is using inflation to liquidate the debt over time.
This means the focus has to shift entirely toward holding the assets that the debt and the resulting inflation are trying to buy. The massive government spending has to flow somewhere.
It flows into the ownership of productive assets and commodities. And that brings us to the third G, gas, which represents energy and raw commodity exposure. Real wealth, at the end of the day, is ultimately measured in energy. If the dollar is constantly being debased, the cost of producing or extracting everything from oil to copper to wheat is constantly rising in dollar terms.
So how does the learner best gain exposure to gas without getting into the complexity of, say, futures trading?
By focusing on energy equities. The productive businesses that own the extraction assets, the pipelines, the processing facilities. You want to be the owner of the physical asset that is being priced up by inflation, not the user who is stuck paying the higher price at the pump. This provides a built-in protection against debasement and benefits directly from the commodity price rises that are driven by the system's inflationary mechanism.
The ultimate playbook, then, is about adopting the mentality of a permanent creditor. Understanding that while you benefit from the system's stability by owning these assets, you are actively insulating yourself from the inflation that is being used to pay for that stability.
That is the ultimate lesson of the $315 trillion architecture. The debt is not a temporary problem awaiting a political solution. It is the permanent engine of the economy. And that engine is designed to perpetually transfer wealth away from those who rely solely on labor and paper currency, and toward those who own hard, productive assets.
We've conducted the forensic investigation. We've revealed the structural necessity of the closed loop, the collateral trap that necessitates perpetual debt, and the ethical vacuum cleaner that transfers wealth via inflation. Now, the learner has the playbook. Get out of the way of the printing press, raise your inflation-proof war chest of gold, position yourself in ground and gas, and wait to become the owner. Understanding this architecture is the first step toward true financial self-reliance in this leveraged world.
Indeed, the forensic findings are conclusive. Global debt is a closed-loop system designed to exist permanently as pristine collateral, just to maintain banking liquidity and the complexity of modern finance. And the necessary cost of this architecture is a structural wealth transfer from labor to capital, relentlessly fueled by the intentional, grinding policy of currency inflation.
And this knowledge, it forces us to confront the massive ethical dilemma at the very heart of this system. Is it fair for the government, in order to guarantee the stability of our current financial civilization, to issue debt that unborn generations will be structurally required to refinance and pay interest on for eternity? Or is this permanent, debt-backed architecture simply a necessary, albeit ethically complicated, trade-off required to maintain the complex technological and financial structures of modern civilization? That is the ultimate question we leave for you to consider.